Hello and welcome to Free Lunch here at Zacks. I'm your host, Ben Rains. U.S. stocks climbed again Tuesday after a strong start to the week on Monday. The S&P 500 closed at a new record for the 9th time in 2020, and the tech-heavy NASDAQ closed at a new record for the 11th time so far this year. The theme remains the same as Wall Street shakes off coronavirus fears. Stronger than expected earnings, which include giants like Apple and Amazon, have propelled indexes, plus U.S. economic data continues to please investors. This includes last Friday's better-than-expected jobs report. Wall Street will also pay close attention to Federal Reserve Chairman Jerome Powell, who began 2 days of testimony before Congress Tuesday morning. Most investors expect the Fed to maintain low interest rates in 2020, and Powell briefly spoke about coronavirus in China early Tuesday. He said that, quote, some of the uncertainties around trade have diminished recently, but that the viral outbreak could lead to disruptions in China that spill over to the rest of the global economy. In company-related news, the merger between T-Mobile US and Sprint is finally going to be approved, according to reports, after roughly 2 years of an ongoing antitrust investigation into the merger. The new company will now become a stronger number 3 player behind AT&T and Verizon, as well as challengers like Comcast. Sprint stock soared more than 50% after hours Monday after Wall Street Journal broke the news. Sprint shares are up big again today, but are still trading at around $8 per share. Meanwhile, T-Mobile stock jumped 10% to new highs. In earnings news, Under Armour stock tumbled over 16% after it said that its U.S. sales would fall again in 2020. The athletic apparel company saw its key North American sales dip 2% in 2019 and said that it expects mid to high single-digit decline in the region in 2020. Then, after the closing bell, Wall Street will turn its attention to Lyft. The ride-sharing stock is up over 12% in the last week. The stock got a boost after its rival Uber shortened its adjusted profitability timetable late last week. Last quarter, Lyft executives said they would be profitable on an adjusted EBITDA basis in the fourth quarter of 2021. So investors should pay close attention to see if they follow Uber and change that timeline. Management also raised its full-year revenue outlook for the second quarter in a row and announced that it expected to report a smaller fiscal 2019 loss. Lyft expects its fourth quarter sales to climb roughly 47% to as high as $985 million. Meanwhile, our Zacks estimates call for the company to post an adjusted loss of 57 cents per share in the quarter. But Lyft's recent positive earnings revision activity helps it hold the Zacks Rank number 2 buy right now. The stock also has miles to climb before it runs into its 52-week highs. And that does it for the news portion of Free Lunch, but stick around for today's new Zacks Rank number 1 strong buy stock. Hello and welcome back to Free Lunch. Today we're breaking down why Splunk is a Zacks Rank number 1 strong buy stock. Splunk provides enterprise-level software solutions, and its tagline is that it turns data into doing, and that it's its data to doing everything platform. The company has been on an impressive run, and it beat our Q3 2020 earnings and revenue estimates. and now it is playing a vital role for many Fortune 1000 companies who are trying to find and analyze their, quote, dark data. That's what CEO Doug Merritt calls the challenge for companies who are flooded with new sources of data in the big data age. So now we're going to dive into Splunk. As always, I like to start with a quick look at the company's website. As we said, and I kind of butchered that tagline, it's the data to everything platform. So they're a big data software company. That's all you really need to know. Obviously, you can dive into as much as you want on the back end, but that's their business: IT, security, IoT, business analytics. They had a big Super Bowl ad this year. Some people might not have noticed it. It's one of those ads where you're kind of like, what is this for? But they're pushing out maybe to be a bigger company than ever before by spending so much on an advertisement. So now we're going to go ahead and take a look at what the company has done in terms of stock price performance, and then we'll look at to see what its estimates look like going forward and why it's a strong buy stock at the moment. So we'll notice that the stock is up about 30%, and this is in the last 6 months. And we can see that after they beat Q3 top and bottom line in mid-November, late November, 11.21. The stock is up big since then. So if we go over the last 3 months, we can see they're up about 34% in the last 3 months, outpaces its industry's 20% climb. And now let's take a kind of a broader view. So let's go over the last 5 years. SPLK stock is up 170%, which easily outpaces its internet software market's 45% average climb. And as we can see, that the last 2 years have been a bit better. They started to separate, and then the last year is where they fell a little bit behind, but we can see that once again that big beat in Q3 has propelled the stock over the last several months up about 34% in the last 3 months. And then we'll go ahead and take a look at some of their growth recently, so to give people a perspective of what to expect going forward. So we can see that in fiscal 2019, which was last year for them, they grew at about 38% on the top line and about 39% the year before that. So their growth we're going to see slow down because they were doing impressive about 40%, 50%, 50% growth. But as you get bigger, those numbers just get harder and harder to make. So we're going to go ahead and look at those estimates. We're calling for about 26% growth in the fourth quarter. And we don't have an estimate here, but just for a little glitch in our system, but I just crunched the numbers myself. We're calling for about 30.5% growth to 2.35 billion, and then another 22% growth in the next year to almost 3 billion, which is some impressive figures for Splunk. And then on the bottom line, we're calling for 40% growth this year, and then another 24% growth on the bottom line. So it's always good for a tech company to see their bottom line growing heavily in the right direction. And we could see that it's these positive earnings revisions that help the company earn its Zacks Rank #1 strong buy at the moment. And also, we should note that they have an impressive history of quarterly earnings beats. They have a 74% average beat over the trailing 4 quarters, with an 11% beat last quarter, but a really, really big beat in Q2 and a big beat in Q1. So look for that. And we should note that going ahead, they are expected to report their fourth quarter and full year results on March 4th. So pay attention to those results, even though we're still in the early parts of February. It's a short month, so March will be here before we know it. So that does it for another episode of Free Lunch. Make sure to also check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. Also, make sure to tune into Paper Traders, which is live at 11 a.m. on Wednesdays. Once again, I'm your host, Ben Rains, and we'll be back next time with more up-to-date market news and a new top stock pick.